So in terms of valuation, where do you stand on valuation now? Because you did mention earlier the dividend is forecast to be cut. That's not perhaps ideal.
No, it's not ideal, but I suppose it was pretty much expected. Looking at the forecast at the moment, I think the payout for the current year is expected to give a yield of about 5.7% at the current price. And forecasts at the moment suggest that yield could fall to just under 5% next year. So still an attractive level of income, even though it's falling. But in terms of value, I think we've got to look at NAV really and the share price. The last reported book value was £28, and the shares at 23 now, they've come down a bit. It's still offering a useful discount, although not as big as it was. But historically, this hasn't always been the cheapest house builder. I think it's relatively rare for Bellway to trade substantially below book value for any period of time. So I think the valuation, it's reasonably attractive.
Welcome to the Private Investors Podcast, the podcast where keen stock pickers Roland Head and Maynard Paton talk about managing their share portfolios. Roland writes about his dividend stocks at rolandhead.com, while I write about my small caps at maynardpaton.com. This time we cover Bellway and the investment potential of residential house building. Let's get started. Roland, on your website, rolandhead.com, the last purchase for your model portfolio was back in October and was Bellway, and your buy price then was £17 and the price now is £24. So you must be very pleased.
I am indeed, although if I'm totally honest, I do feel the share price rally we've seen since October may have been a little bit too good to last. But yeah, I'm very happy so far, and I'm hoping that I might get a chance to buy a few more.
I think you captured the low points, even below the £19 seen during the March 2020 pandemic crash, and matching the £17 even seen after the mini Brexit crash of 2016.
Yeah, it's not very often I manage to catch the bottom. So I think regardless really of what happens next, I'm comfortable that the shares did offer some good value at £17 and hopefully will provide some attractive returns.
I looked at house builders at the same time as you were buying Bellway for SharePad. I wrote about Redrow at £4 and they're now £5. And on my SharePad filters at the time, there were 5 house builders, including Bellway at £17. Anyway, house builders, Bellway, it's a FTSE 250 house builder with a £3 billion market cap. What did you like about the shares back in October?
In general, I think house builders can be a good buy if they're well capitalized and if they're trading below book value. And certainly back in October, Bellway and most of the other big firms were trading below book value. I think Bellway was nearly 40% below NAV at the time. But I chose Bellway for a few reasons. One of those really was because I think the company has a more conservative financial track record than some of its rivals. So if we take a step back, Bellway is based in Newcastle, was founded in 1946, and it's been listed on the London market since 1986, so it has quite a long record. And unlike some of its rivals, it didn't need any rescue fundraising when the housing market crashed in 2008. And although the dividend was cut, the company didn't actually skip a single payment during that time, which many of its peers did do. Certainly Bellway didn't go through the kind of near-death experience that some house builders suffered. So that conservative record was one attraction. And another thing that appealed to me really is during the boom market we've seen over the last few years, the company has maintained quite a high level of dividend cover. What that has meant now is that management have not immediately needed to slash the dividend in the way, again, that some rivals have, for example, Persimmon. So for me, this conservative record is an attraction, and I think it's also been reflected in the share price performance. Bellway, by my reckoning, Bellway has outperformed most of the other house builders over the last 10 years, although in not Redrow, funnily enough. But there you go.
I must admit, I almost wrote about Bellway for SharePad instead of Redrow. It's just that it had results around the time of publication. So I chose Redrow instead because it had just published its results. But I think you chose the better option with Bellway rather than Redrow. Does Bellway now represent a large part of your model dividend portfolio?
Bellway started out as just under 5% of my model portfolio, and the share price gains since then mean I think that it's about 6.5% today, and a similar proportion of my own portfolio. So yeah, it's a substantial holding, but not disproportionately so. I'm not putting all my eggs in this one basket.
You said in your buy report, from what I can tell, the group's positioning is slightly above mid-market with a focus on quality. I think you're right. So the last year, the average Bellway home sold for £314,000. Private homes went for £349,000 on average. The average social housing Bellway sold was £160,000 per unit. They have what they call a artisan collection, and they describe this collection as combining meticulous craftsmanship with architectural flair to create exceptional homes that our customers can be proud to live in. So I've checked the Bellway website, and the cheapest property I could find is in Rutchill, which is a suburb of Glasgow, and that is for a one-bedroom apartment for £129,000. And at the other end of the scale is a 5-bedroom detached house in Kings Hill, which is near Maidstone in Kent, which is up for sale for £800,000. So just over half of Bellway's homes, they are sold in Southern England. The rest are sold throughout the UK. And it's not just stylish kitchens and bathrooms. So part of the marketing sales pitch now is innovative home working. 100% ultra-fast broadband when you move in. That's now a key feature on the website. So last year they sold 11,000 homes, or just over, although now the sales numbers look set to decrease over the next year or two, which brings us on to the cyclical nature of house building. In your buy report, you mentioned this business faces clear cyclical risks. So house building in general, not an obvious home for super steady dividends, but I guess you are happy with the industry ups and downs.
Yeah, I think that's a good point. Probably most investors understand that the UK housing market goes through these boom and bust cycles, and that certainly is reflected in house builders' dividends. And again, this is one reason why I liked Bellway's more conservative approach. But taking a broader view, I suppose I'm looking at the returns I hope to see over the whole cycle. And on that basis, I think Bellway can deliver attractive cash returns. So if we look back, Bellway's dividend rose steadily from the early 1990s until the 2008 crash when it was cut. And then the payout began to rise again from about 2010 until the start of the pandemic. So looking at the last 10 years alone, Bellway has paid about £10 a share in dividends since 2013. Now, in May 2013, the share price was just over £13, so that's a cash yield of 80% over 10 years, or about 6% a year annualized. And the share price has risen alongside that payout too, also by around 80%. So the shares have delivered a total return of something like 10% a year over the last decade, by my reckoning. And if I can get a similar return over the next 10 years, I'm quite happy to ride out the ups and downs and take a broader view.
Bellway's track record is impressive. SharePad, amazingly enough, has financial data going back 40 years for Bellway. And so looking at SharePad and Companies House, sales 40 years ago were £39 million, and last year they were £3.5 billion. So sales are up 90 times in the last 40 years. Profit 40 years ago was 3 million. Last year was more than 600 million. So profit's up 200 times since the early 80s. Dividend was 6p 40 years ago. That's up 23 times. Net asset value was £1.15 40 years ago. Last year it was £27. So that's up 23 times. So yes, as you said, there were setbacks. Late 80s, early 90s, difficult time for the housing market. 2008, 2009, which we'll touch upon in a second. Difficult time. Pandemic 2020, difficult time as well. Do you know how much a Bellway house cost back in early 1980s? How much they sold for?
No, I'm afraid.
I've checked Companies House. There's an old annual report. In the early 80s, they were selling between £18,000 and £80,000. In one of the old annual reports, there was a testimonial from a couple who were thrilled to move into their 2-bedroom flat in Croydon and were happy to have paid £26,000. And checking on Rightmove, I think now if you wanted to buy a 2-bedroom flat in Croydon, you'd be paying 10, 15 times at least.
It's a strong track record, or a long track record, and I think that's part of the attraction. This business has been through quite a few cycles successfully.
Has it all been due to house price inflation? If you go back 15 years, with the last housing peak in 2007, Bellway sold 7,600 homes that year. And last year they sold 11,000 or so. So that's up 45%. But the average selling price of a Bellway home over those same 15 years, that's up 80% from 174,000 to 314,000. So a lot of the impressive growth has just been due to general house price inflation. There's an interesting statistic Bellway started publishing about about 10 years ago, which is the average selling price per square foot of their homes. And that has tracked the average selling price per home as well. So what that means is the average size of a home Bellway has sold has not changed over time. It's still around 1,000 square feet. So what that's telling me is that Bellway are not selling bigger or better houses. It's just they are benefiting from general house price inflation over time. So have you viewed a Bellway house? Have you seen a site or development?
Funnily enough, just a couple of weeks ago, I was staying in a fairly new home, and right across the road, there was a brand new estate being built by Bellway. So I took a walk around one evening. The show home and the offices were closed, but I did have a good walk around, and the feeling I got was generally that the houses looked good quality with kind of higher specification windows and doors and things, and just a good standard of workmanship externally compared to some others. So I suppose I would say I got the feeling there was better quality than average, and I was also struck by the quality of the cars on the new homeowners drive. It certainly gave an impression that they had above average incomes and that these new houses were attracting quite affluent buyers, which matches up to my impression of the company's positioning in the market.
That's a good sign, the cars, the type of car outside on the drive. I should be fair to Bellway here because I've done some research into the average size of homes, and I always get the impression that new build houses, they try to cram as many homes as possible onto a site, and the homes are getting smaller. I found some statistics from Zoopla. So go back to the 1930s, and the average size of a living room in the 1930s is 16 square meters. By the 1970s, that had increased to 25 square meters, but now the average living room is back to 17 square meters. It's the same with kitchens. 12 square meters in the 1930s, increased to 15 square meters by the 1970s, back to 12 square meters now. So over the last 50 years, houses have been getting smaller. So Bellway keeping the average size of its house over the last 10 years the same is actually quite commendable, I think. So Bellway houses have been getting larger relative to everybody else's house. So house builders, do they have moats? What are your thoughts?
I don't think many people buy new homes often enough to create a significant body of repeat custom. But I think when you look at the big UK house builders, it's probably fair to say they do all have slightly different characteristics that help to distinguish them in the market. So with Bellway, it's got a long history and I think a quality positioning compared to some of the other big builders. So I think that probably the company does have a certain amount of brand equity, but I wouldn't go so far as to describe it as a moat. But more generally, what I would say is I think the biggest house builders collectively in the UK do have some commercial advantages over smaller rivals, just due to their financial firepower and to the way that the UK planning and land buying system works. I think size is a general advantage.
I think you're right. And also, I think a lot of it boils down to land buying. If you can buy land at the right price in the right location, then as long as your houses are reasonably adequate, they will sell. Shall we talk about the finances and cash flow? Because you said in your buy report, Bellway scores consistently highly for dividend cover by earnings, but free cash flow cover for the payout has been weaker and less consistent over the last decade. So are you satisfied with cash flow?
I am satisfied, yeah. I think this goes back again to what we were saying a few minutes ago about the returns through the cycle. Looking at the different points in the housing cycle, Bellway's profit margins, the amount it spends on land and construction, all of these things will vary over, say, a 10-year period. But if the business is well managed, then over the whole cycle, it should generate satisfactory levels of free cash flow. Right now, I think it looks like we're at the end of a fairly strong market cycle. Bellway is coming out of that with plenty of cash, almost no gearing, and has also paid some very attractive dividends over the last 10 years. And there's one other factor is while falling profit forecasts do look a bit scary, the shrinking order book and the reduction in volumes should also mean that Bellway frees up some cash that's currently tied up in working capital. So over maybe the next 6 to 12 months, cash generation could actually be better than you might guess from profit forecasts.
Yeah, this is a cash-intensive business. So lots of cash is paid up front to buy the land and build the home with labour and materials. And then the cash rolls in once you've sold the house. So on a simplistic way of looking at Bellway, if it builds more houses than it sells, then cash flow can look pretty awful. But if it sells more houses than it builds, cash flow can look fantastic. And earnings can diverge from free cash flow significantly because of that. So over the last 5 years, free cash flow was over £900 million. total versus total earnings of £1.9 billion. So there's a £1 billion gap between free cash flow and earnings. And that gap reflects the sales proceeds from houses that have been reinvested in new land to replenish the land bank and build new housing developments. So in terms of free cash against the dividend, it looks pretty adequate, I think. So 5 years, £900 million or so for free cash flow, paying dividends of 700 million. That's 1.3 times cover. 10 years, 1.3 times cover. 15 years, total free cash flow of 1.5 billion versus dividends of 1.2 billion. So the best way I think of looking at cash flow is that it's building up NAV, net asset value, on the balance sheet. The cash is all being put into stock and new housing developments, the capitalizing of wages and materials. And that all goes onto the balance sheet. So you look at net asset value, how that's moving, and you look at net asset value for valuation. So I would buy primarily on a net asset value basis and if things go well, you also get a dividend as a bonus. So what are your thoughts on the balance sheet as things stand now?
Just while we're talking about cash flow, there was one thing I was going to mention that probably is worth flagging up as a risk, a specific risk over the next few years, which is under the government's building safety pledge. So this all relates to the cost of making fire safety improvements to buildings following the Grenfell Towers fire. Bellway doesn't build apartments anymore, but it has done in the past. And so far, the company has allocated almost £570 million for expected expenses, which covers buildings constructed since 1992. Now, what's interesting, or what's potentially significant, is that most of this cash outflow is expected over the next 5 years. So it could be a bit of a headwind to free cash flow and maybe to dividend payments over that period. It's not clear to me how much of an impact it will have. It probably a lot depends on conditions in the housing market, but it's probably worth bearing in mind for anyone considering investing because it's potentially quite a serious amount of money.
What are your thoughts generally on the balance sheet?
I think in any kind of stable market, I would say the balance sheet looks very strong. The latest results from the firm covered the 6 months to the end of January and showed a net asset value of just over £28 a share, with more than £400 million of cash on hand. But given that we could be heading into a market slump, I think the acid test at the moment is to what extent Bellway could unwind its short-term obligations if housing sales grind to a halt. Could the company suffer a liquidity crunch? I think that's what we need to understand.
Yeah, there's net cash in the last accounts of almost £300 million, which is reassuring. Is that surplus cash, though? Because you look at the payables, which total £1 billion, including £400 million or so of obligations to buy land, unpaid expenses of £400 million or so, customer deposits of almost £200 million, which you can't really include as the company's cash. Yeah, the balance sheet seems okay. I think it's important to realize that in any housing market downturn, a lot of the cash has been spent on the land, the labor, materials building these houses. The accounting profits may look awful in a property price crash. Cash flow ought to be a lot better, assuming Bellway stops buying land and cuts right back on the new developments and sells many more houses than it builds. Like you, I think Bellway should be okay. I think
I think it should be fine. But we've talked about net asset value a little bit already, but it's probably worth explaining that a big chunk of this expected value is tied up in the company's land bank. So it can only really be converted into cash through more construction and sales in the future, isn't it? So what's your view on the state of Bellway's land bank?
It's better than it was. So there's 61,000 plots in the bank, of which 32,000 have detailed planning permission and 29,000 have outline or awaiting planning permission. I think there's about 40,000 or so other plots which have some sort of speculative value. But just looking at the 61,000 plots, there were sales of 11,000 homes or so last year. So the land bank is about 5.5 years of land, which compares better than the 4 years from a few years ago. So they've been buying more land recently. So the total number of plots is up 50% since 2018. And the supply at 5 years is about the industry average. It's the same as Redrow when I looked at Redrow last year. What is surprising to me is the cost of the land. So last year, the average house sold by Bellway was £314,000, but the associated land was just £56,000, which represented about 18% of that selling price. I always thought with builders, they paid a third for the land, they paid a third for building the house, and a third was left over for profit. But seemingly I'm completely out of touch, because 18% of your selling price for land, I thought was surprisingly low. So I estimated that the average home Bellway sold was £314,000 last year. Of that, 180 went on building materials and labour costs. So for management to keep control of costs, they've got to look at not only land buying, but also labour costs and material costs as well. So land is not the greatest expense, but it's still important to think about the land cost. You have to bear in mind stock profit as well, what's called stock profit. So Bellway buys land and builds houses on this land over 5 years. Over those 5 years, let's say house price inflation is significant. When you're selling the last houses after 5 years, your profits could look fantastic because your land is expensed at cost after 5 years, and it can form a relatively small part of your selling price. But on the other hand, when you buy land and you build houses on for 5 years and there's a house price crash during those 5 years, and you'd be selling that expensive land versus a very low selling price, and that can take up a disproportionate amount of your profit.
So I always like to look at investments in terms of what could go wrong, and what you're saying about margins and the cost of land purchases is certainly a problem that affected some house builders back in 2008. Did Beltway suffer that sort of problem back when the market crashed?
Yeah, they had a problem of they bought land, I think as most builders did at the time. You look back at the 2007, 2008, 2009 accounts, and the number of houses they sold fell 43% during those 3 years. So they sold 7,600 homes in 2007, got down to 4,400 in 2009. The average price though, of each home sold, that only fell 11% during those 2 or 3 years, down from 173 to 154. And the write-offs on the balance sheet, that represented about 11% of the stock during those few years as well. So what killed house builders during that time was not so much price falls, it was just the number of houses sold dropped dramatically. They cut the workforce by 50% during those 2 or 3 years, which is understandable when you're selling 40% fewer houses. I think there's some assumptions in the annual report, isn't there, about 2008 and stress testing, I think, some of the accounts.
Yeah, that's right. And what you're saying is almost reassuring in a strange way, because management have said that their financial modeling they've done recently, their severe but plausible scenario is for a 50% drop in sales over the next year and a 10% drop in house prices. And in the report, they say this is what happened in 2008. And obviously your numbers bear that out. So they've been through it before, including, I think, some of the same management team, and they've worked through the numbers again now. And they're comfortable that there wouldn't be any financial stress on the business that couldn't be easily managed. That's obviously the official line, but looking at the accounts, do you see any signs that we could be facing a repeat of 2008?
No, I think it's worth bearing in mind that the business has net cash now of almost 300 million. Back in 2007, they had net debt of more than 100 million. So it's a different cash situation. And also, it's pretty instructive going back to the 2008, 2009 accounts, because they had net debt of more than 100 million in 2007, and they borrowed an extra 250 million in 2008. And you must have thought at the time, well, that looks a bold move, but they repaid it all back in 2009. It's incredible. What they did was they just stopped buying land and just completely reduced the levels of construction. So they sold far more houses than they built, and the cash all rolled in, and they paid off all this debt. It was just incredible. And this restarted buying land in 2010. But in terms of any obvious signs of a crash around the corner from the accounts now, I don't think so. Looking at the 2007 accounts, the only thing I saw of any sort of note was development land. All of a sudden that increased considerably versus the value of the work in progress, which is the houses which are half built. Development land all of a sudden became more than double the value of the work in progress. It's typically about 1.6 times. And at the moment, in the 2022 accounts, it's 1.7. So development land values are not running away from the cost of expenses at the moment. So in terms of obvious signs, I can't see anything in the current accounts, or there's nothing obvious looking back at 2007 either. I think the general killer for house builders is volumes drying up. Mortgage funding dries up and you're left with half-built site. But as I say, there's cash in the bank now, so the balance sheet looks a lot different now than it did 15 years ago. And 15 years ago actually is a long time. I mean, we're talking about 2008. It's 15 years ago. I keep thinking anyone in the city younger than 35 or so is probably not experienced how depressed markets and housing markets can become.
Yeah, it's fair to say there's no substitute for experience in this kind of situation. People who've actually been through it before and have navigated their way through it successfully before. And Wething, we talked about that in the last podcast when we were discussing James Halstead too, the benefits of an experienced management team. Personally, at Bellway, I'm quite happy with management. I think they seem experienced, pretty credible to me. Is that your impression as well?
Yeah. So the chief executive, he's been chief executive since 2018 and been at Bellway since 2005. The finance director, he's been finance director since 2012, been at Bellway since 2008. So I think both of them seem a safe pair of hands. I think if they were not up to the job, shareholders would have found out by now. The interesting person on this board is the chairman, John Tutt. So he's a non-executive, but he's ex-Redrow, and he was appointed chief executive of Redrow by Steve Morgan when Steve Morgan was chairman. Now, Steve Morgan founded Redrow back in the 1970s and turned Redrow into one of the UK's largest house builders. So he knows everything there is to know about house building and house builders. So if he appointed John Tutt as his chief executive, you can be sure that John Tutt knows something about house building and house builders.
Yeah, I agree. I think it's a very reassuring appointment, especially compared to some house builders whose chairmen seem to have more financial experience than building experience. But I'm pleased that you're happy with the top management team too. But I'm guessing you aren't quite as keen on the latest incentive packages that they've put into place.
Nothing irritates me more than a badly designed LTIP, and this is badly designed. I say badly designed. It may not be badly designed for the executives, but let's see about shareholders. So the executives get awarded a LTIP every year, and the targets are over 3 years. So in 2021, they were issued an LTIP for the 3 years to 2024, and if Bellway recorded earnings of £3.84 over that time, they would get extra shares through this LTIP. So earnings reported that year were £3.50. They get higher earnings, and if there's higher earnings, they get this share award. Fine. So you move on to last year, and you get the board are issued another LTIP, this time for the 3 years to 2025. So the earnings target this time for 2025 is £4.10. But you look at the earnings for last year and the £4.21. So hold on, you get lower earnings 3 years in 3 years' time, but you still get a share award, which doesn't sound great. So they made the LTIP easier, but also the size of the award has increased as well. So it was 150% of salary last year, but that's increased now to 200% of salary. The only mitigating factor I can think of is tax, because the rate of corporation tax has increased to 25%. There's also a property development tax as well included. So maybe that is factored into these bonus targets as well. And Redrow have done the same. So it's not just Bellway here. But the general impression is from this LTIP and the remuneration committee sitting around the boardroom thinking about what earnings are going to be in a few years' time to set these bonuses. You think earnings are going to be very good over the next few years. That's the impression I'm getting from this LTIP. There was a bonus as well, the annual bonus. Last year, they just needed 5% growth to get an annual bonus. The year before, it was 20%. Chief executive last year got an £841,000 bonus. There's no AGM protest votes. I know we've talked about protest votes before on previous podcasts. So shareholders seem to be pretty happy on pay. Shall we talk about the latest results? What did you think of those half-year results?
Yeah, I don't think there was anything particularly worrying about the numbers. Sales for the half year that was to the 6 months to the end of January. Sales were broadly flat compared to the same period in the previous year, but some costs had risen as you'd expect. So earnings were down by around 8% and profit margins were slightly lower. But the dividend was held unchanged. The interim dividend was unchanged at 45p per share. And profit margins were still really very impressive, with an underlying margin of 17.5%, I think. Really, to be honest, my biggest concern about the numbers is that they were so strong, they may have given investors a false sense of confidence about the outlook. While the numbers from the last 6 months may be good, I think it's clear from the company's guidance and commentary, and from what other house builders are saying too, that things are likely to get much worse before they start to improve again.
Yeah, the order book does not look great. I mean,
No, it doesn't at all. That was one of the more forward-looking pieces of information in the results, and what we saw is the value of the order book is down by 27% compared to March last year, and the number of units in the order book was 22% lower, near more than a fifth a reduction in the number of houses on order, and they're cheaper houses too.
yeah, private homes, they've said down 40%, which is
Yes,
which is a shocker. Social housing up 22%. So that's saving the day. I noticed private homes, the pricing of private homes is holding up at around £360,000. But they did say the order book will reduce by July 2023, which is their year end, and a lower volume output is expected in FY24. So that's not ideal at all.
no, from what I've seen, I don't know if Bellway have provided a number yet for the next year, but Persimmon and Taylor Wimpey in the recent updates, they've both given forecasts for completions over the next year, and they're between 30 and 40% lower than the previous year. So really a big drop off in construction is being expected. Without reading the recent results carefully, you could possibly have overlooked that, I think, with the strength of the historic numbers.
Second half average selling price looks low to me because they're forecasting for this year selling 11,000 homes at £300,000 each. And if you look at the first half, these results, the average selling price was 317,000. So for the full year, if the average is 300,000, then the second half, the price drops to £283,000. So no wonder they've been talking about a moderation to margins. And something else not great is admin expenses. They seem to be rising next year, even when house volumes are down and revenue is going to be down as well. So that's not great. So yeah, the forecasts for 2024 are not looking great. If you extrapolate the second half and the selling houses for an average of £283,000 throughout 2024, and the cost of each house remains at about 250,000. There's a real margin squeeze about to happen in the second half of 2023 and throughout 2024, I think. So yeah, gross margin, I reckon, could be 12%, down from 22%. I can see why revenue of 2.8 billion is forecast for 2024, which is down 20% on last year.
The numbers don't look brilliant. I think broker forecasts at the moment suggest pre-tax profit next year, so that would be from August through to July 24. Profits could be down by nearly 40% to 340 million, which would be half the 650 million they reported last year. And the dividend cut is also being penciled in about 15%, I think, at the moment. One benefit, hopefully, is that the higher level of cover they've maintained up till now will mean that the dividend cut might be smaller than the reduction in profits. If construction is slowing down, they might be freeing up some cash to help support the payout. But certainly an uncertain outlook, I think, is fair to say.
What is interesting now is the buyback program. So they've committed to spend, I think, up to £100 million. Is that a good idea right now? Would you prefer them to shore up the dividend, because you've said it's forecast to be cut, or prefer Bellway to keep the cash on the balance sheet?
It's a difficult question. I think I wouldn't want to see the cash just paid out as special dividends at the moment, because that would weaken the balance sheet and it wouldn't provide any kind of lasting value creation, in my opinion. Mathematically, it should be good to buy back shares when they are trading below their net asset value, because doing that should increase the net asset value for the remaining shares. Obviously, there's a part of me that would prefer the company just to sit on the cash at the moment to maximize the margin of safety. I think a buyback is reasonable in this case. I'm trusting or hoping that management have done their sums right and that the market isn't surprised by a deeper downturn than anyone's expecting right now. What's your thought on the buyback? Would you support it?
It's a dilemma for management. It's a classic capital allocation dilemma. Do you reinvest in the business or buy back stock? Or do nothing? I mean, I can understand them buying back stock because it's in theory cheaper to buy land, housing stock on the LSE through buying shares, because you're buying at a discount to NAV than in the real life property market. Should you just keep the cash instead, just in case if there is a downturn? Management could be heroes if they could keep net cash and have cash on standby, and if there is a downturn, they could mop up lots of cheap land and be heroes for shareholders. I mean, you've got to trust the chairman has approved this buyback. He knows about house. So you've got to think he has approved the buyback and management aren't doing this buyback. But the record for buybacks in the FTSE 350 is pretty poor anecdotally. I keep thinking of BP and Glaxo spending billions on buybacks. It's just been wasted. So can't help but think, is it another example of just buying a load of stock at the wrong time? So not sure. Shall we talk about the housing market and the mortgage market? That's going to influence Bellway's progress. So what are your thoughts on the housing market?
I try and avoid making too many predictions about the housing market because I think every time I have ever tried, I've often been wrong. But I think there's not really any escaping what is happening now. Even certainly where I live, houses were selling within weeks almost at any price, and now they're not. Even properties that would have been attractive are just sitting on the market. So I wonder if we're in a bit of a standoff where sellers won't lower their prices, but buyers can't or won't pay quite as much as they were. And obviously, higher interest rates are one big reason for this. I think, according to recent figures from Nationwide Building Society, typical mortgage rates have doubled over the last year. And in addition to this, the market is also adjusting to the withdrawal of the Help to Buy scheme that's run since 2013. And then more recently, various stamp duty holidays during the pandemic, which also provided a quick boost for prices. And we've got all of this dropping out of the numbers now. So my guess is we could see a period of adjustment where sales volumes slow. We've still got inflation, the cost of living pressures for many people. So a lot of the outlook will depend on the strength of the economy, but I'm not banking on a really quick bounce here. I think it could be a little while till things pick up again.
Yeah, I tend to agree with that. I think trends in the markets tend to last longer than people expected. So if you go back to 0% base rates in 2009, I don't think anybody expected them to be still effectively 0% 12 years later. And I think base rates at 4 to 5% or maybe even more, maybe here to stay for a little while yet. And all that has to come through into affect the housing market at some point when people remortgage and just the cost of mortgages, and that will eventually get reflected in the housing market generally and the prices Bellway can achieve for its home. Like you, I don't see a huge housing market crash on around the corner, but a long period of stagnating prices. So in terms of valuation, where do you stand on valuation now? Because you did mention earlier the dividend is forecast to be cut. That's not perhaps ideal.
No, it's not ideal, but I suppose it was pretty much expected. Looking at the forecast at the moment, I think the core payout for the current year is expected to give a yield of about 5.7% at the current price. And forecasts at the moment suggest that yield could fall to just under 5% next year. So still an attractive level of income, even though it's falling. But in terms of value, I think we've got to look at NAV really and the share price. The last reported book value was £28, and the shares at 23 now, they've come down a bit. It's still offering a useful discount, although not as big as it was. But historically, this hasn't always been the cheapest house builder. I think it's relatively rare for Bellway to trade substantially below book value for any period of time. Not really much in the last 10 years, as far as I can see. So I think the valuation, it's reasonably attractive. Personally, I'd probably wait to see if the shares fall back a bit more before I consider buying any. But I do think on a longer view, the price is probably quite reasonable at the moment.
It's certainly trading at a relatively low valuation against net asset value. Over the last 10 years, I think it's traded at about 1.3 times net asset value on average. Has been as high. I think it's almost double net asset value. These shares were over £40 just before the pandemic. Now they're 24 or 23, and you bought at 17. It's historically, this is a low rating. And I think you've got to go back to 2008, 2009 to get any deeper. Certainly where you were buying, you've got to go back to 2008, 2009 to find any cheap rating for Bellway. Going back to when I wrote about Redrow, I said it was a very intriguing opportunity, which was code for probably worth buying at that time. I think if I was a deep value investor, didn't really pay too much attention to management, I just looked at the numbers, I think I would have been buying heavily into house builders back then because the discounts back in October were significant to NAV and they were just too good to ignore. Yeah, I can definitely see why you bought and the attractions. And I think I'd be looking to buy more if there's more worries in the market, I think, for this sector.
Yeah, I think that being able to buy housing related stocks in good financial health at prices ratings similar to 2008 seems relatively low risk to me, barring anything unforeseen.
You've got asset backing here. It's land, it will sell at some point to somebody. it will be turned into cash. It has a value, and you can buy below that NAV. I think there's reasonably low risk. I know who we should talk to about deep value investing. Mark Simpson, co-host on our sister podcast, the Value Trapped podcast. He's a deep value investor. He likes to buy shares below book value. I wonder if he could tell us whether Bellway and house builders are value bargains and value traps. And also Bruce Packard, his co-host. He's an ex-banking analyst, and he's always talking about 2008 and bank balance sheets and all the mortgage funding and all the rest of it. So maybe we could have a four-way discussion between us about whether house builders are really value bargains at the moment or value traps.
Yeah, I think that could be a very interesting discussion, and certainly good to get an alternative viewpoint.
But in the meantime, you bought at £17. Well done.
Yeah, I'm looking forward to seeing how it pans out, really.
Well, that's it for this time. Thanks for listening to the Private Investors Podcast. If you enjoyed the podcast, please let us know by liking, subscribing, or even leaving a review. Until next time, thank you and goodbye.